As people start to trickle in here, we can go ahead and get started. Keep it somewhat tight here. Welcome everyone to the latest edition of the Elm webinar. My name is Jerry Bell. I've spoken with a number of the folks I see on the call. One of the partners here at Elm. A quick some housekeeping on how this will work. I will kind of tee things up, and then Victor and I will walk through some slides, and hopefully save the majority of our time together for questions at the end. If you have questions that are going to come up throughout the course of the conversation, feel free to drop them in the chat. There's some other folks from Elm on the call. Who will be answering questions periodically, and then anything we don't get to or that they think may be better for kind of a forum discussion, we will leave and Victor and I will do kind of an MC act where we'll handle questions live. Before we get into it, I wanted to introduce James White, who's Elm CEO. He is not going to be able to join us for the call, but we did want to make sure to say hi to everyone who's here with us. I don't know if James, if you have anything to say.
Hey everyone. I've been Elm CEO since 2018. Um, I also have all of my liquid wealth managed by Elm. And, somewhat unusually, I think the way that happened is not that, I joined Elm and then, Victor pressured me to have Elm, manage all my money, but that, long before I joined Elm, Elm managed all of my money and all of my liquid money, at least, which is most of my wealth. And then it just became natural to, for us to work together also.
Okay,
Yep.
in the interest of keeping this relatively tight, let's jump into things. As I mentioned, we're going to talk about a few things. We're going to spend a little bit of time walking through Elm's approach, dynamic index investing, how we think about it, how it works, some of the mechanics, and why we think it is a sensible, straightforward way for people to think about managing their savings. And then we'll spend a little bit of time talking about the different ways that people access Elm. For a long time, we've been managing separately managed accounts at Fidelity, Schwab, and JP Morgan. Most recently, we have listed an ETF with the ticker ELM, and we'll talk a little bit about why we did that, the differences between the offerings that we have for our investors, and then, like I said, we'll save as much time as possible for Q&A at the end, and then go from there. Without further ado, I will throw it over to Victor.
Great. Thanks, Jerry. So, you know, the basic tenet of our approach is that there's really no such thing as passive asset allocation. That asset allocation is always going to be and has to be an active decision where investors are taking their expectations for the reward that they get from different asset classes, the risk of those asset classes, maybe the interrelationship as well, and combined with their own personal degree of risk aversion and circumstances, that leads to an asset allocation. And as expected returns and risk change, so too should one's asset allocation. Once you accept that it's an active decision based on expected returns, then it follows that it's going to probably be somewhat dynamic. And that's really I think that's really the distinguishing feature of our philosophy, that we are very comfortable with passive investing when it comes to getting exposure to all of U.S. equities, the U.S. equity market or the non-U.S. equity market, using index funds, market cap weighted index funds for those. So they're being passive and holding individual stocks in proportion to their market cap makes sense. But when it comes to the asset allocation itself, that we can't say, well, how much equities exist in the world, how much bonds exist in the world. Let's just be passive and go with a market cap weight of those things. That no, at that point, we have to bring in the expected returns risk and risk aversion. So, when we, people naturally have thought about this. This isn't like some sort. This goes all the way back, for 60 years of modern finance and the way people have been thinking about things for forever, really. Um, but so we get a lot of people that are very interested in dynamic asset allocation. Dynamic index investing is really what we call our approach because we're not only doing dynamic asset allocation, but we're using low-cost index funds to do that. And sometimes we get objections from people, or people are concerned that yes, I really like the idea of dynamic asset allocation, but isn't a buy and hold approach going to be more tax efficient? And from the point of view of individuals trying to do that, they might say, well. If it's really hard to do this myself. It's just better to like set it and forget it and not spend a lot of time on my asset allocation. And I certainly don't want to be doing like some kind of very subjective seat of the pants market timing. So, I think that in other words, dynamic asset allocation makes sense to people, but people do have legitimate concerns regarding it. And that's, we think, why there's so much attraction for people to do a static asset allocation. It's kind of like, well, I would do dynamic except for these issues. And we think that we've come a long way in addressing and solving these concerns. So as we say, we think there's hope. And our approach, dynamic index investing, we like to think about it as saying that we're trying to combine the best things of passive index investing, the low cost, the sort of maximal diversification, transparency, liquidity, tax efficiency, and combining that with the best things of long-term rules-based active investing as well. And so we really think of what we do as being the synthesis, trying to take the best of passive, the best of active, and putting it together into our approach of dynamic index investing. And you'll notice there's a trademark there following dynamic index investing, where when we started Elm in 2011, we went to the US Patent Office and Patent and Trademark Office and said, we would like to trademark the product dynamic index investing. And after some discussions and back and forth with them, they agreed to give us the trademark for it because A, nobody else was doing it, and B, they actually didn't think it was a generic term. That they recognized, the U.S. Patent Office people recognized that this synthesis was a real innovation. Um, so, um, so let's talk a little bit more about exactly how we do it. I mean, I think as we go through the rest of our prepared remarks, we're going to be trying to focus on the mechanics of how we do it. And one thing that I'll say is that everything that we do is fully transparent. The reason that we charge such low fees is because we think that we're doing something that we didn't invent, that makes a lot of sense, and that should carry a really low fee. There's not like a black box, some secret black box that we've created here. We're doing things that we think are really just best practice, and it's important to deliver this investing approach at a low cost. So, so we start off, well, we're going to talk about this a little bit more later, where we have two ways of delivering our services to clients. One is through separately managed accounts, and the other is through funds and ETF that we have, and some funds for non-US investors as well. But let's just say that whether it's a separately managed account or it's our ETF, that we start off with a baseline that we think is going to be representative of what a client wants in a world in which things are kind of normal. And what we mean specifically by normal is that the stock market in general and globally is offering about a 4% return above safe assets. And we're not in a high risk or particularly low risk environment. And so let's say in that world, a client wants to be 75% in equities and 25% in fixed income, and we'll call that the baseline asset allocation. So again, with separately managed accounts, the clients are telling us what they want their baseline allocation to be. For our pooled products, we had to make that decision as being kind of representative of what we think users of our product would want. So let's say we start off with a 75-25 baseline, and then we're going to use uh, two metrics or two considerations to change that asset allocation away from the baseline. The first one is obviously expected returns. And actually, by expected returns here, we mean expected returns of equities relative to safe assets. So we're thinking about the excess expected return. And the higher that is, the more we want to own equities, and the lower that is, the less. And where do we come up with that expectation? Well, we use what we think is kind of the most useful and simple metric for long-term expected returns for stocks, which is just the earnings yield. We're using the cyclically adjusted earnings yield, and we make a few other adjustments for payout ratios, but we're using an earnings yield metric for the stock market to give us an estimate of the long-term real return that stocks are offering. And what we find is we're using this really simple metric of earnings yield, but every large investment firm actually publishes their capital market assumptions. What do they think is the expected return for US stocks and non-US stocks? And turns out that the average of Goldman Sachs and PIMCO and Vanguard and BlackRock and everybody is pretty close to the earnings yield. We've been tracking that from some time, and we publish our numbers every quarter as well. And that's that's kind of the natural way to think about long-term expected returns. So the higher or lower that is, the more or less we allocate to equities. And so that's the first metric, which makes sense, we think. And the second is that let's look at how risky the market is at a moment in time. And if we're in a very high risk state, we're going to reduce exposure to stocks. And if we're in a low risk state, we'll increase. We use a proxy for the riskiness of the marketplace. Instead of directly measuring risk, we actually use a momentum metric, which is simpler than trying to sample risk from options or realized volatility. And we think it does a really good job, and that's what we've been using. There's not a big difference. Like right now, for instance, I think that every metric that you would use would tell you that US equities are in a high risk state right now. Whether you're looking at the VIX, whether you're looking at realized volatility, longer term option volatility, or our metric, our proxy metric of momentum, all of those are saying we're in a high risk environment. So that's what we're trying to get at, is have something that's a simple way of just deciding, are we in a high risk or low risk? So for high risk, we're going to have less exposure. So right now, when we look at the global equity market, expected returns are relatively low compared to safe assets. Not super low. US is lower. Non-US equities is not as low. And most of the global equity markets are in a high risk state. So when we put those two things together, you see that our asset allocation, instead of being 75% equities, today our asset allocation is more like 40%, 48% equities, or something like that. I mean, it's moving around day to day, week to week, and over 50% in fixed income. Jerry, back to you.
Yeah, so to kind of flesh out what Victor was just describing, on our website on a daily basis, we publish an updated version of our asset allocation. And so you can find this table underneath the allocation viewer on our website. And basically what you're looking at here, if you've never seen this table before, you're looking at basically everything Victor just described, the risk premia for each of the asset classes that we hold, and the risk level for each of those asset classes we hold. And like as hopefully was coming through, we really value transparency, and we are constantly publishing how we sort of interpret these two signals and how that flows through to our current asset allocation. And so this is a 2 days stale, but you can kind of see very, very underweight US equities relative to the baseline, relative to a 75-25 US non-US global equity fixed income baseline. So we're quite underweight US, which you can see in that second column. but actually still a bit overweight non-US, given that, as Victor was saying, expected returns are still they're not super high, but they're high relative to our baseline. And risk levels are a bit mixed, but as of 2 days ago, they were still low from using the momentum signal that we look at. And so, like I said, this is published on our website every single day. Um, One of the things that we think about, and we get a question a lot from our clients, is this dynamic approach, what does this look like over time? And so as you can see on the right, a 75-25 baseline has had a pretty healthy allocation to equities, even though that's floating around depending on expected returns and risk. It is a relatively healthy exposure to equities that we've seen in the baseline. This will obviously change. Obviously, it's lower than that average right now. But that will change depending on expected returns and risk going forward. And then one of the things another question we get a lot is, so as we are thinking about implementing these portfolios, what are the types of instruments that we're holding? We have a really simple set of simple framework for the ETFs that land in the Elm portfolio. They have to be extremely low cost, they have to be very large, and they have to be extremely liquid. And so those are sort of anything that doesn't cross those barriers tends to not make, kind of to land in our world. And so you can kind of get a sense for what this may look like in a regular Elm portfolio. Now, in our separately managed accounts, we're actively doing tax loss harvesting on a regular basis, and so we may be swapping out a Vanguard ETF for an iShares or a State Street ETF on a regular basis, which is obviously very beneficial from a tax loss harvesting standpoint. But we don't ever swap into a different ETF that doesn't kind of cross that threshold for things that are really important to us. And I guess the last thing to show, so we charge 12 basis points in our SMAs. We charge 12 basis points as our management fee, and then the underlying expense ratios for the funds will typically be in the 5 to 6 basis point range. Now that'll change as our asset allocation changes, but typically it's in that range, and thankfully continuing to come down as these large asset managers continue to cut their fees, which is fantastic for us, fantastic for you, fantastic for all index investors, which we really like.
Back to me again.
Back to you.
Yeah. So, I think that it's useful to talk a little bit about the types of environments in which what we're doing really helps returns and risk-adjusted returns, versus other times. So, in general, the let me start with a little bit the more favorable environments, because I think that's kind of a little bit clearer to think about. So, the two times historically, and both of these are within simulation periods because we only started in business in 2011. But the approach that we use would have done really well in the global financial crisis and also in the dot-com bust. And in the latter part of the dot-com bust, that is. Um, and where we're going to do well in general is where markets are either showing some low expected returns and we're underweight as a result of that. And then we get into sort of a prolonged correction, a prolonged bear market, which is what we had both in the GFC and also following the dot-com run-up, where everybody kind of thought that equities were not offering a very high expected return relative to safe assets. And then once things started to turn and we started to get a normalization of this risk premium, it took some time for it to happen. It didn't happen right away. It took a longer period. And so that's I think that the biggest help that we can give to portfolios is protecting the downside or not losing as much money as you would have in a static asset allocation going into a bear market. Also, I would say that like in the latter half of 2020, following the terrible sell-off in stocks in early 2020 at the beginning of COVID, once it became clear that a vaccine was coming soon, once it became clear that the government was going to spend as much money as needed to prop up the economy, the markets kind of settled down and started going up, and they staged that rally from a point where the excess expected return of equities versus safe assets was really quite high, mostly driven from interest rates getting pushed way, way down. Long-term inflation protected bonds had negative yields at that time, and nominal bonds also were trading pretty close to a 0% yield. Um, so the earnings yield on equities went up as the markets sold off, but mostly that expansion of the risk premium that drove us to be overweight in the back end of 2020 was coming from lower interest rates. Now, in general, the type of environment that's most challenging for us is environments where we're kind of, you could think of it as getting false signals of these prolonged corrections and bear markets. So, I would say that since 2011, since we've been in business, we've had a bunch of times where, it looked like the market was going into a longer term correction, and then, we got government action, we got interest rates getting cut or whatever that, really turned things around very, very quickly. Um, Also, another kind of environment that's really tough for us is where um, we think that expected returns of an asset class is low relative to safe assets, but that asset class just keeps on doing well. And that's really been kind of the overarching story of the last 13 years has been US equities just doing so well, even as the earnings yield relative to safe assets has generally been coming down and down and down. Particularly in the last 4 or 5 years, I would say, away from 2022. So, just to bear in mind that those are kind of the types of environments that are good and bad. We're not sure what's going to develop from where we are today, but this has been that since the inauguration on January 20th, we've been um, in a relatively measured correction for equities globally and U.S. equities in particular. And, we've been, that being dynamic the way that we've been has been good so far. We don't know, whether tomorrow the markets are going to be up 10% or not. And, sort of be that, maybe this is going to turn into a shorter term correction. But the way that we are approaching it using our simple set of rules is that, it's the beginning or early stages of a longer term correction in terms of how the portfolios are positioned. So anyway, just wanted to give you a little bit of that overview. Um, so back to you again, Jerry.
Sure, sure. Thank you. Yeah, and I guess the one more note on performance. So for our separately managed accounts, we do have a performance returns tool that you can see the performance of an Elm portfolio at different dial settings. We're not able to publish that on our website for regulatory reasons, but if you send us a note, we'd be happy to share that with you after the call. And then for the ETF, as of hopefully today, we're able to our returns will actually be on the ETF website, which we can talk about in a bit. Um, so how to work with
Jerry,
Elm?
can I just
Yeah,
quickly say a small thing is that
please.
we're getting really good questions in the chat, and we're going to be trying to answer all of them through speaking rather than typing. So just bear with us, and we're going to get to these questions. I'm reading them, and I'm like, these are great, great questions that we're going to be really happy to talk about.
Great. So there are a few different ways to work with them. The way I sort of describe it is we have basically one strategy and then a couple ways to kind of access it depending on your preferences, your tax situation, et cetera. Um, I'll start on the far right. We do have a non, I think there are a few international folks on the call. We do have a non-US fund. It's a private fund listed offshore. We're not going to spend a bunch of time on that today, but we have materials if that is of relevance to you. Certainly reach out. But we're going to primarily talk about our offerings for US investors. We have separately managed accounts that are custodied at Fidelity, Schwab, and JP Morgan. Um, these there's a lot of really nice things about separately managed accounts. A few of the ones that we really like, it's totally customizable. So you can change your baseline depending on a number of things that I'm going to talk about on our next slide. But one of the biggest things is that you can contribute cash or held assets. We often work with clients who have appreciated assets or something from a previous manager, and they're looking for a way to sensibly diversify around this holding that they may or may not be ready to sell. And so that's something that we regularly do. And for the majority of our separately managed account clients, as they're getting started with us, we're spending a lot of time working with them to figure out a tax sensitive way to develop an Elm model portfolio. And so that's a really nice offering, something that we do, like I said, regularly with our clients. Um, I do have a minimum on this account, and it is $2 million. The difference between that and the ETF, which we'll also spend some time on, is that the ETF is not customizable, right? It's a single fixed baseline of the 75% equity, 25% fixed income, but does have the full kind of dynamic approach that Victor was describing earlier. The ETF is only about 2 months old right now. However, it is the conversion of an older private fund that sort of goes all the way back to Elm's inception. And so while the strategy I mean, while the product has only been listed publicly for about 2 months, it does have a full 14-year track record. The strategy has been in place for an extended period of time, and we actually have SEC approval to use that track record, and so that is available on our fund website. It is as far as we know available on most online brokers. There's a few that we're still sort of working through. Various brokers have different rules about what can and can't be listed, and we're sort of tackling these things on an ad hoc basis. But as far as we know, it is available on most online brokers. But if it's not, certainly let us know, and we can see what we can do to help you there. And then obviously there's no minimums to invest. It's just a $25 share price. So a few notes on the separately managed account. So as I mentioned, one of the really nice things about this is that it's more or less fully customizable. There are a few sort of standard questions that we work with clients to answer as they're getting started. The big ones obviously are how much equity risk do you want to be taking in this baseline environment? Um, in our ETF, that number is 75%. However, different clients have different circumstances that they may desire a higher or a lower equity baseline. Those are things that we're accommodating all the time. We're also spending a lot of time helping people figure out what that correct number is for them. And so most of the time when clients are opening SMAs with us, we're typically spending a lot of time on this left dial to make sure that it's comfortable, both as the Elm, one that it feels right for their Elm approach, but also that it fits correctly with the rest of their savings. The second dial is determining the split of US versus non-US assets in that equity baseline. And again, this is a place where we hope that it is able to make Elm fit nicely with the rest of what's happening in your portfolio, in your investing. We in our ETF, and then sort of philosophically, we support a neutral market cap weight split between US and non-US, but we regularly work with clients who prefer to add some level of US or non-US bias within their baseline. And then lastly, clients have the ability to customize how dynamic their portfolio is. So 0% would be a fully static portfolio where we're just rebalancing the portfolio to your baseline weights, whereas 100% would be fully reacting to the expected return and risk signals that we were describing earlier. Again, in our ETF and in our private fund, this is set at 100%, but clients have the opportunity to set this wherever they like. And some of the reasons that people may choose to set it at a different rate, it could be they want a slightly more tax efficient approach. They want something that's a little bit more close to their baseline. They sort of are anchored to a baseline and they want to stick closer to that. These are all things that they're more than happy to accommodate. But and I should say before we move on, this is just the starting point of the customization. We can more or less fully customize the entire portfolio. Oftentimes, clients are coming to us with relatively nuanced tax situations, and there's a lot of different things that we can do to adjust the portfolio to reflect your tax preferences, both now and in the future. So if that's you, more than happy to have that conversation and kind of talk about how we think about these things.
So we get a lot of questions these days now that we have the Elm ETF traded on the New York Stock Exchange, comparing SMAs, separately managed accounts, and the Elm ETF. And I'm not going to read through all of these, and Jerry and I have talked about a number of the things already. Maybe I'll just expand on a couple of different things. Uh, One, the $2 million investment minimum, we raised that when we launched the ETF because now the ETF is giving everybody a chance to get in, to become investors with us without uh, needing to do an SMA. So we thought it made sense to raise the minimum and try to give more focus, uh, be able to give a bit more service on our SMAs as well. The $2 million minimum is across all of a family's accounts. So if you have an IRA and a taxable account and trusts for your kids or whatever, we count all of that towards that. I think I'd like to say a couple of words on taxes at this point, and a little bit also on the trading of the ETF. Um, so, so first of all, on taxes, first of all, you'll notice that we're showing a fee of 24 basis points for the ETF versus 12 basis points of management fee for the separately managed accounts, plus 5 basis points in separately managed accounts for the underlying ETFs. I think on this earlier slide, we showed 6 basis points as the average. It kind of changes, and in general, it's coming down as Vanguard and others continue to reduce the fees they charge on their index products. In the case of the ETF, the 24 basis points is including the fees of the underlying ETFs. So to make like for like, it's really like 19 basis points of management fee, let's call it, versus 12. But actually, for us, we're actually making less than 12 basis points on the ETF because we have to pay a bunch of expenses to a US bank for helping us to have this ETF be available that we don't have with the SMA. But the nice thing in the ETF is that the 24 basis points of fees that are in there are all being deducted from income within the ETF. And so you could really think of, for taxable investors, you could really think of the 24 basis points as being a pre-tax number, and that on an after-tax basis, it's closer to the fees charged in the SMAs, because in the SMA, the 12 basis points is not being deducted from income, and so is more of an after-tax fee. So just putting those two things next to each other in that way, we thought makes sense. Um, we manage our separately managed accounts. We're very focused on fees, the things that we can control: fees, taxes, diversification. Those are the things that we have the most control over. And we want to keep fees and taxes as low as possible for people and diversification as high as possible. So in separately managed accounts, we manage taxes through a combination of tax loss harvesting, where we can be very efficient with tax loss harvesting in separately managed accounts, because for every exposure, there's different ways to hold it. And so we don't get caught up in the wash sale rule very often. We're able to uh, sell and replace ETF holdings in separately managed accounts pretty freely without introducing a lot of tracking risk. And so we do tax loss harvesting there. And also in our rebalancing, we try to be tax aware also, so that if we need to reduce equity exposure, but there's unrealized gains in the equities, we don't go all the way down to the target. We go closer to the target. We move towards the target, but we take account of tax realizations as well. If we're going up, if we have to increase equity exposure to go up to a target, there's no tax issue there. And so we're able to get closer to target allocations on the way up. But between tax loss harvesting and tax aware rebalancing, the SMAs are quite tax efficient. They're never going to be as tax efficient as a pure buy and hold, where you never incur any taxes at all. But we get a lot of the way towards that full tax efficiency, and especially for investors that can use tax losses outside of their ELM accounts. Um, then the tax efficiency can even be greater than buy and hold, because you can actually get some losses that help with other parts of your portfolio. And in the early days of an ELM investment, you'll probably get some short-term capital losses from the tax loss harvesting, which have a lot of value and can really over the life of an investment make it very tax efficient indeed if you've got some short-term gains elsewhere in your portfolio. Um, in the ETF, you're not getting the benefit of the tax loss harvesting that's throwing tax losses out that you can use against other gains in the rest of your portfolio. But the mechanism of creation and redemption, always in kind from an ETF, allows us to manage it very tax efficiently. And our hope is that there will be very little or no realized capital gains coming out to ETF investors over time. So I'm sure many of you know that ETFs are a very tax efficient structure because of this in-kind redemption and creation process that allows ETF sponsors to send out low basis holdings when there are redemptions and to take in at market basis when there are creations or subscriptions to the ETF. And overall, the ETF can be very tax efficient in terms of generating long-term deferral. We really hope that despite all of the trading that's going on in the ETF, we hope that we're going to be able to manage things in such a way that there'll either be very little or no capital gains distributions to investors over long horizons, also assuming US tax rules remain as they are, which we expect to be the case for the foreseeable future. So anyway, I hope that kind of helps you to get more of an idea of one versus the other. Also, our ETF has UK reporting status. So if there's anybody on the call that's a US taxable investor living in the United Kingdom, the ETF is a really good tax solution, is a very tax efficient solution for you. We think you have to get your own tax advice on that, but we do have UK reporting status for the ETF. And I think we have one more slide before we'll get to the questions. So, although as Jerry said, our ETF started trading in early February, but we have that the ETF was a conversion of a fund that we started right at the beginning of Elm at the end of 2011. So we have an audited return track record for Elm going all the way back to the end of 2011. And we can compare that to obviously, we're going to look somewhere in between the return of bonds. Given that we have this 75-25 baseline, we're going to be somewhere between the return of bonds and stocks. That's what you get with a balanced portfolio. And you can see that over, I think, all of the horizons, we've kind of come in somewhere in between stocks and bonds, which are the two last columns, two last bars on the right in each one of those groups. We're using as a publicly available benchmark a Dow Jones Moderate Risk Index benchmark that has a little bit of a dynamic allocation to it as well. And, we think returns have been, pretty decent, over the last 10 years, a small amount of outperformance and also lower risk as well. So a higher Sharpe ratio. We also, I think in comparing like to like, there's also a little bit of tax exempt income and a little bit of withholding tax credits that are there that make a little bit of a positive difference. But overall, we're happy with our realized returns to date. It hasn't been the greatest environment for what we're doing, but we think it just is a really sensible way of investing. And all of us at Elm are using Elm ourselves to manage the bulk of our own wealth also. So anyway, these numbers are going to be on the Elm Funds website that's dedicated to information about our ETF. And with separately managed accounts, since all clients have accounts which are customized for them in some way, we don't really have a particular track record there, but we do have this return tool that Jerry was talking about that can show you, based on how we do things, what would be historical returns and asset allocations going back over any horizon you want, even back over 100 years. We've populated return data in our database so that people can look over any horizons. Obviously, as you go further back, less of the asset classes existed. TIPS only started in 1998, for instance, but still, you can use those tools to see asset allocation and returns, simulated returns over time with care. So um, I think that brings us
Yep.
to the end of our prepared remarks, maybe a little bit, tiny bit longer than we expected.
As per
And
usual.
but we have some great questions that we'd like to get to now, and keep them coming.
So before we get into the Q&A, I will say on the Elm website, elmwealth.com, we do have an extensive FAQ that's got a lot of questions about a lot of common questions about everything from our approach, sort of account mechanics, SMA versus ETF, a little bit about the firm, a little bit about tips, which we get a lot of questions about. All of that can be found at the in the FAQ section of our website. I'll start. Why don't I start with the question, and then Victor, you can find the one that you'd prefer to. So we just
Okay.
got a question about someone contributing a basket of individual stocks as the beginning of their separately managed account. This is very common. This is something that we do pretty much regularly for our clients, and we typically handle it in a few ways. The question was specifically about how quickly does the rebalance happen, and the answer to that is it's mostly the client preference, right? If a client is very tax sensitive, we will and doesn't have any interest in realizing gains. Perhaps all of these have short-term gains. It's very common. What we'll typically do is map those individual stocks onto the Elm asset class that they, typically fit into. The common case would be instead of holding the Vanguard, Vanguard's broad U.S. index, we'll hold your Apple or your Microsoft that you just contributed instead. And if you prefer to never sell that, maybe it's got really a large amount of gains, we'll just hold that position as part of your U.S. allocation indefinitely. If you decide that you've had a great run, you're really happy with the Microsoft performance, but you prefer a more diversified portfolio, we can sell that at our next weekly rebalance. It's totally up to your preference. And like I said, we are regularly customizing Elm portfolios depending on the kind of nuanced tax preferences of our clients. Maybe you live in New York today, but you're planning on moving to Florida next year, and you would prefer to sell then and not now. That's something that we're doing all the time. So if that's you, if that's a common something you've been thinking about, happy to discuss how that would work within an Elm portfolio.
Great. So Martin Petri had a question about tax efficiency of the SMAs versus ETFs. I hope we've answered that. I think that we think both of them are really tax efficient. Perhaps depending on again what you have going on outside of Elm, the SMA could be more tax efficient if everything that you have is with Elm, and so you can't use capital losses outside. The ETF is a little bit more tax efficient, but we're really talking about 10 basis points of difference or something like that, to some long horizons. So I hope I answered that well. There's a question from Andrew about is weekly rebalancing too frequent? And so I guess I'm not sure if we hit on this in terms of how we do the rebalancing. We for SMAs we rebalance weekly. For the ETF, we're doing it at least twice a month. We're probably going to move to weekly for that too. But when we're doing weekly rebalancing, we're moving the portfolio. The target is basically a 4-week moving average, so that you could think of it, as we're moving, the target is a 4-week moving average, so that gives less turnover, less activity. You could also think of it as almost that we're rebalancing a quarter of the portfolio every week. Is equivalent to what we're doing is another way to think about it. So we like the idea of moving smoothly, but there's definitely some frequency of full rebalancing that we would feel is just too frenetic, is too much for what for people's preferences, and is starting to have a diminishing return to activity. So we definitely wouldn't want to rebalance the portfolio all the way to targets every day or even every week. So there's that one. And I think Mike, you answered that in there as well. Yeah, and lots of times there's no trades at all. The There were a couple of questions around all of that. I think that let me give an overall answer to a number of questions that when we've been making decisions about how to operate and how to implement the basic idea of dynamic index investing, um, we constantly are confronted by the choice of doing something which, might be better or we think could be somewhat better, but adds to complexity and lack of transparency. And so, a number of questions that we've had in the chat in the chat windows are asking like, what about doing it this way? Wouldn't this be better? Or doing it that way, wouldn't that be better? And in general, we do think that there are things that would be better, but there's this trade-off that we're really concerned about in terms of really trying to make things so simple and transparent that people can really follow what we're doing and uh, versus adding complexity. So that's always in our mind whenever we're thinking about improvements, and we are changing what we do. That over the last 13 years we've been evolving and we think doing things better and better. But we're very cognizant of this trade-off, so we're always open to trying to do things better, and it's just getting over that threshold of ease of explaining to everybody what we're doing versus the benefit of trying to do things a little bit better. Jerry, do you want to choose some or
Yeah,
Mike or Brandon?
I was getting I was typing. I was answering questions and typing. So
Okay.
let's
Yeah,
see here.
lots of answers. Mike and Brandon have answered lots in the group chat also about maybe having a European listed ETF. We hope we're going to do that. That would be great at some point.
There's actually a really good question. Probably Victor, you probably have some thoughts on this as well. About the most effective way to trade the ETF. So
Ah,
when trading the ETF or trading any ETF really, we strongly recommend using limit orders, not using market orders. And one of the things that is really nice about Elm is that the underlying ETFs that we hold are some of, if not the most liquid ETFs in the entire world. And so even if the spread on, if you're looking at, Fidelity or Schwab or whatever broker you're using, if the spread for Elm is looking wider than you might expect, we have had great success getting, and our clients have had great success getting filled at, a something close to the midpoint, maybe a few cents to the bid side of the midpoint, because our market makers are, like I said, these are highly liquid underlying securities, and we've found really good liquidity, even tighter than the sort of the published spread. But we do strongly recommend using limit orders when buying when buying Elm.
right. And yeah, I'll also add to that. So the liquidity of the ETF is really the liquidity of the underlying holdings of the ETF. So even though, each day we might see $1 million or $2 million of the ETF trading right now, which is generally people putting some money into the ETF, um, there's a whole lot of liquidity that the market makers are willing to provide. So if somebody wanted to buy $20 million, it would be no problem at all because the underlying liquidity of Vanguard's U.S. stock market index fund or Vanguard's European stock market index fund, the liquidity of those things is hundreds of millions of dollars each, on the wire. And so there's a lot of liquidity that's kind of available, even though it's not trading a lot. And the other thing that I think is, possibly worth adding is that the market makers, that since we launched the ETF, I think almost all of the flows have been people putting more money into the ETF. And so the market makers are seeing this and they're basically pricing the ETF at a small premium to NAV at most of the times. But also the market makers are quite happy to do large trades at the closing bell of the New York Stock Exchange at 4 o'clock Eastern Time, and to do those trades as a spread to the NAV of our ETF. So, like if you have an account at Fidelity or Schwab or JP Morgan, in particular, and I think other places too, you would have to talk to their trading desk. It's not something that you could type in as a type of trade, but you would talk to the trading desk and say, I would like to buy a couple $1 million of the ELM Market Navigator ETF. And can I do that as an NAV trade where I'm buying it, say 1 cent above the closing market NAV of Elm? So just something to keep in mind. It really depends on your relationship, et cetera. But that is another way of buying and buying effectively the ETF. I mean, any ETF, not just ours. Any ETF you can do that with. It does have to be larger size to sort of go through the trading desk at most places, but yeah.
Maybe do one more question. What do you think?
Yeah, I think, yeah, I mean, I was thinking maybe we could really also go a little bit later too, if necessary, because there are some really good questions. But let's take at least one more right now. I really like this question that Ben asked. What kind of back testing do you do
Okay.
to quantify how often you're right versus wrong, et cetera? And I think that back testing is really something that's great to talk about our view of back testing. So our overall view is that investment approaches should be forward-looking. And unfortunately, we just don't have enough. There's just not enough financial data. I mean, yes, we have 100 years of US stock market data, but that data is really not so powerful in telling you what's a good way to invest. So we believe. So what our approach has been was to come up with what we thought was a sensible way to invest, which we've described to you on this call. How we use expected returns and risk to drive our dynamic asset allocation. So we came up with that, 15, 16 years ago. Like, this is how we'd like to invest. This is how I wanted to invest for my family. And then um, we did do a back test, but the back test that we did was much more of an exercise to invalidate the idea rather than to validate it. So the idea of the back test was to go back and say, well, listen, if this is a bad way to invest, we're not going to do it. I don't want to do it. But it wasn't the idea of the back test wasn't to validate or to search over what's the best way to do it. It was really to give a test of rejection, to try to see whether it made sense to reject this approach to investing rather than to validate it. So I think that we believe that this approach to investing makes sense from a logical point of view, and we would say that it's not contradicted by history. In fact, in our back tests, one of which is published in the Journal of Portfolio Management, we show that, oh, this actually worked really well historically, but that's not why we're doing it. We think that we're doing it because we really think it makes sense. And I think that's our overall approach to investing, is to try to think about what do we like and feel really comfortable with that. And then, yes, check it against history and make sure that it's not actually, for some reason, we're missing something. It's a terrible way to invest. And there was a question about factor exposure. And, that's kind of why we don't really have much, we don't have much strong belief in doing factor investing. We don't have a quality factor, or we don't have a big value or a small cap factors in what we're doing. We like the idea of using mostly broad market cap weighted index funds. We do have a little bit of buckets for value and small cap in the US, but that's more to just be representative. And because the US bucket was so big, we wanted to just break it up a little bit for to make things a little bit smoother. But, we're not really big believers in factor investing. We wrote a piece that won an award in the Journal of Portfolio Management as well on our skepticism around factor investing. If you're interested, just send us an email and we can send you the journal article, as well. But that's our overall thinking about back testing, is like, yes, back test to reject, but don't back test to come up with a strategy, we would say.
Great.
Yeah,
Um,
any other questions that did we, yeah, we have a couple of minutes, but yeah, maybe I kind of feel like we got most most of them, but please, if you feel that we didn't answer your question, just email us or let's have a meeting or email us and we can write back, in more detail. I think these were the best questions we've had in our webinars. Um, really good set of questions, and I hope that we've answered all of them. But please, yeah, just email us, email Jerry or Vic or any of us at elmwealth.com, and we'll give you a more comprehensive answer on any of these things and send you materials and point you to things.
Great. Well, thank you everyone for joining us. I've left some of the various contact information up here on the screen. Hopefully, you know where to find us, and if you have a follow-up question or you want to talk about something more specific to your personal situation, those are we like those questions a lot. So please do get in touch.